We have seen previously what are the common mistakes made by investors when investing in mutual funds. Now we are going to see how to avoid these mistakes. What is the most best way wherein an investor can avoid such mistakes? And then we are also going to see what are the things you need to be aware of when you want to sell your mutual fund units. So, let us see how to avoid the mistakes which investors today commit while investing in the mutual fund portfolio. So, the best way to avoid this mistake is to have goals, to have financial goals for yourself. I mean, if you have a goal like you just want to become rich, then if you see your capital depleting in the next year, you want to exit. There is no goal attached. It has just one single goal as you want to become rich. Well, you don't know what the rich do, but you want to become rich. If you know what the rich do and replicate the exact behavior, how they have become rich, then you could as well become rich. But you end up listening to tips and tricks from different quarters of in the industry. So be a little mindful before you start investing. Start writing your financial goals. It might be education for your children, it might be a marriage plan, it might be retirement plan, it might be vacation plan, it can be anything. Just write your financial goal. They have to be smart enough. They have to be, when I say smart, it has to be specific, measurable, achievable, A, R, realistic, and T, it should be time bound. Now, everything is time bound. This life is time bound itself. So, once you have your goal, whole your whole action should be towards meeting those goals. Your whole action should be towards saving for those goals, right? So now you should have bucketized these goals. You should have like three buckets of goals. One is your short term goals of 1 to 3 years, and then you have a medium term goals of 3 to 5 years, or maybe even 7 years, that range, and then 5 years or 7 years and beyond as your long term goals. So within 1 to 3 years goal, you could have selection of debt or conservative mutual funds. You could expect returns of about 8 to 10% with very less volatility, very less risky. So you can achieve those short-term goals by being conservative with your particular capital. You do not want your principal amount to be, in too much negative area. If you are in the equity market, like it has happened in the just previous year or this year, we have seen the bull run and then suddenly the markets are going down. We have seen the trend line data. In 2022, it was a good performance. 23 was not so good performance. I hope I remember the years correctly. But nevertheless, you can refer back to trend line. You can see how the annual returns were. They are not having a consistent return, but average returns you could expect. Now, in the previous 3 years, average was about roughly 10%. But why would you want to take the risk of equity investing for 3 years if you have an equally performing, better performing asset which is conservative enough with less volatility for short term? And then you have a medium term, which is for 3 to 5 years or 7 years, wherein you could select hybrid funds or balanced funds, which is having a balanced approach to equity and debt. You could expect a good percentage of return so that you can fulfill those specific goals. It could be, children's education. You have children's fund plan as well, which has a lock-in for 5 years. Then you have retirement funds as well, which are hybrid or balanced funds, which have a lock-in of 5 years. So, but if you withdraw before 5 years, then you will be charged a penalty or a very high exit load. And then finally, you have a long-term bucket wherein you can invest for your long-term goal, which could be, a vacation trip after you exit from your active work life, or it could be a retirement planning to fulfill all your lifetime expenses. So by having these buckets, your purpose then becomes oriented towards fulfilling the financial outcome of each and every bucket. It's not oriented towards checking what is the daily performance of the stock market. By doing it this way, then your whole focus moves towards saving. It could be in any instrument depending on your goal. So this is one approach of how you can avoid all the mistakes by just being focused towards the goal. Once you have achieved the goal, take it, then you go to the subsequent goal. You keep meeting each and every goal as you go along. And definitely a financial planner, financial advisor is definitely of great help, a great motivator if you want to invest in the mutual fund industry. So now that you have known how to avoid it, now we'll see some of the things which you should keep in mind when you sell mutual funds. Now, when you want to sell mutual funds, there are three things which you need to be aware of. One is the exit load for mutual fund. Now, coming up on the screen, you see the exit load for various classes of mutual fund. For equity funds, if it is redeemed within 1 year, it's about 1%. Then for debt, it is usually 0 after 7 days, right? And for index, you have 0% exit loads in most cases, and hybrid you have typically 1% within a year. Then you also have to be aware of the expense ratios when you want to buy, because expense ratio, you need to pay the fund manager, the team, they do various activities, they do valuation checks, they filter out quality stocks for you, and they invest in the right companies, quality companies, so that your capital can grow at the expected rate of return to fulfill the objective of that specific fund. So let us see some of the expense ratios across different types of mutual funds. In the equity mutual fund, we see in the direct plan, we see maximum expense ratio of 1%. Then you have for debt, you have 0.8% maximum. Then you have for index, you have 0.3% maximum, and hybrid, you have 1.5% maximum. So these are the expense ratios which you need to be aware of when you're buying either a lump sum or a SIP. Then the third aspect which you need to be aware of about the long term or the short term capital gains upon selling your units. Now, if it is a equity mutual fund, which is the focus of this particular discussion, if it is an equity mutual fund, if you sell the units in less than a year, then it will be considered as a short term capital gain, and you will be charged 20% tax irrespective of your tax bracket. Whether you are in 10% tax bracket, also you will be charged 20% short term capital gain. So the benefit is that if you are in the 30% bracket, even then you will be charged 20%. And then if you have sold your units after a year, then you have long term capital gains applicable. Up to 1.25 lakhs per investors is exempted, and after 1.25 lakhs, whatever gains you have made after deducting the cost of the investment, then the gains whatever you have made, that will be taxed at 12.5%. So if you are in the 30% bracket, still you will be charged 12.5% of the gains. Even if you are in the least bracket, even then you will be charged 12.5% gain. So these are the things you need to be aware of when you either want to enter the mutual fund or if you want to sell the mutual fund. Do read my book on investing. It's more about how you can pick up direct stocks. It also gives some suggestion of an alternate approach other than direct stocks. And the stocks which I have suggested in the book, that is Dodge the Recession, is more on investing altogether. It shows you what kind of portfolio allocation you need to have So definitely it's going to be of help. It's a very easy to read language. It's a very easy to follow process which you can follow any year, any time of your career. You can read the book, and if you have any questions on the book, please reach out to me.